Hello and welcome to Moving Iron Podcast. This edition of the Moving Iron Podcast is brought to you by AgDirect. No matter how you buy ag equipment from a dealer, auction, or private party, AgDirect can help you finance it. You can even apply online at agdirect.com. Learn more about your financing options at agdirect.com.
Moving higher in the 21st century. Hard-working people working hard for you and me. Moving higher, time and time again. Through the years you'll find us here. Moving higher.
Hello and welcome to Moving Iron Podcast number 253. This edition of the Moving Iron Podcast is brought to you by AgDirect. No matter how you buy ag equipment from a dealer, auction, or a private party, AgDirect can help you finance it. You can even apply online at agdirect.com. Learn more about your financing options at agdirect.com. I have a repeat guest, Tyler Ehmke from CoBank is here with us, and Tanner is nice enough to come on and talk about what's going on. So you were on last month. We talked about some stuff about how, you had some projections of what you were kind of thinking about was going to happen through the end of the year, and lo and behold, a black swan of black swans gets chucked into the middle of this, which, there's war and conflict, those kind of things bounce around all over the world all the time. But when you're talking about a country like Russia that is not only a large energy producing country, but also the largest wheat producing country, and then the country Ukraine that they're working trying to take back over is another large wheat producer, growing in corn and soybean producer. The Black Sea region is a huge exporting sea area, and no one knows how long this is going to last and what this looks like. It's just a huge event that's happening right now. So Tanner, I guess as you take a look at what's going on here, I guess how do you even start to speculate on what you can see happening and the backlashes that come from something like this throughout the rest of the year?
Well, I think you described it right, Casey. It is a black swan event. Now, some would argue they saw this coming from a long ways back, because of Russia's annexation of Crimea.
Right.
That was just staging for a bigger invasion later on down the road, and now here we are many years later. That was back in 2014. So, however you want to put it, black swan or predictable geopolitical event that we just got complacent about. Here we are with extreme market volatility across all agricultural commodities, across energy markets. Anything that's a commodity right now. Well, anything that can be traded right now is in extreme volatility, whether you're talking stock markets or commodities, what have you. And so I think there is nothing that's going to be unaffected by the events that are transpiring right now over in Ukraine. But I think specifically as we look at agricultural commodities, obviously the grains are going to be experiencing extreme volatility because of the amount of grain volume that is exported out of the Black Sea region. You mentioned wheat. Obviously Russia and Ukraine combined are major wheat exporters. Combined, they're about 26% of the wheat trade. But I think there's a lot of uncertainty here, especially when you look at fertilizer, because all of agriculture is impacted by fertilizer, and Russia and Belarus and Ukraine combined are major exporters of all kinds of fertilizer, whether you're talking nitrogen or potash, you name it. If there are sanctions on those fertilizer exports or disruptions in that trade, we are absolutely going to see uncertainty there in the fertilizer markets going forward. Now, add into the fact that Russia is a gigantic exporter of natural gas. They're not bigger than the United States. We are bigger. We are the biggest producer of natural gas in the world, but Russia is a major exporter, especially into Europe. And natural gas is the feedstock for anhydrous. So how does this impact farmers in the United States? Well, here we just found out yesterday, Germany has canceled their plans for approving Nord Stream 2, which is that natural gas pipeline to Germany.
Right.
And then, other natural gas flows would be impacted as well. That doesn't mean Europe's going to stop requiring energy. or stop requiring natural gas, how their needs going to be met? Well, it's going to be met from the United States shipping liquefied natural gas over to Europe, because we are major producers as well. That's going to subtract the amount of natural gas in the United States that can be used for fertilizer production. And natural gas is the feedstock for anhydrous ammonia. 70% of the cost of anhydrous ammonia is in natural gas. So we are going to see, unfortunately, extreme volatility in natural gas and fertilizer prices in the United States for this foreseeable future. We don't know how long this thing is going to last with Ukraine and Russia. Conceivably, let's say it ended tomorrow, that Ukraine just quits and says, okay, you can have the country. We quit. Russia's in charge. Peace, ultimately, right now. That doesn't end the sanctions.
Right.
The conflict may persist for who knows how long, with perhaps side battles going on for many months, or perhaps even years. You may have renegade groups of Ukrainians that are going to keep fighting the Russians and causing havoc in supply chains. Who knows how this thing is going to last? Nobody knows. If we want to look at history here, not that Iraq and Afghanistan are great barometers of what conflict may look like, but we were in those countries for 20 years.
Right.
And it was still caught when peace was never achieved.
Right.
In that amount of time. And so who knows how things could go with Ukraine if we're going to look at our involvement in Iraq and Afghanistan.
Right.
So we are looking at a highly uncertain situation here with supply chains and markets, and we just don't know what to think out of this invasion, other than we're going to have volatility. And we know that we had inflated energy and fertilizer prices coming into this situation, and now it's going to get worse. And so all we can say at this point is that if we're going to be shipping a lot of natural gas over to Europe, that's going to be decreasing the availability of nat gas in the United States for fertilizer production. That's going to be elevating fertilizer costs through 2022, and that's going to be impacting acreage this spring ultimately. We can talk about that here in a moment. But one final point here, Casey, on natural gas is that I mentioned earlier, we're the biggest producer of natural gas in the world. That doesn't mean we're going to be increasing production. You got to look at what's going on with the producers out there that are drilling for oil and natural gas, and they have they have responsibilities to their shareholders to pay down debt, to pay off shareholders, and it had been years of lower energy prices for quite some time that they've been struggling with. So they've got to get caught up, and they're not necessarily going to be ramping up production with oil at $100 a barrel, or natural gas prices at it's $5 a million BTU. They're going to be imposing austerity here. Really, I think their shareholders are imposing austerity on these energy companies in the United States to reward the shareholders and pay down debt and short their balance sheets. So we won't necessarily see supplies respond accordingly to prices, and that's going to keep energy prices and natural gas prices elevated for the foreseeable future, and that therefore Casey is going to keep fertilizer prices elevated. So an uncertain situation here with austerity in energy production in the United States colliding with the uncertainty we're experiencing now in commodity markets with grain and fertilizer and energy over in Ukraine and Russia. So this is not what the American farmer needed at this time. This is the last thing we needed. However, farmers are going to be benefiting from higher commodity prices. It's just on the production side of things. That's the problem. How high will fertilizer prices go? Although farmers may be capturing more revenue from higher agricultural commodity prices, whether you're talking about grain or livestock or dairy, you name it, that is the positive. The negative here is the higher inputs, and it is higher across the board. It's not just energy or fertilizer. It's labor. It is machinery prices, which you've been talking about every day, every podcast that you do. And then you've got land prices, cash rent prices. You've got supply chain issues that are ongoing. Transportation costs remain record high. Add all of this in, and that quickly erodes whatever margin a farmer thought he might have. Mm-hmm. Now, there are very few farmers out there that bought their fertilizer last year. I've talked to a few farmers out there that have been very smart on this. and they are laughing their way to the bank right now. But I would say that those folks are few and far between. Most farmers right now are trying to figure out what they're going to do this spring with the high input costs, especially with fertilizer and fuel that they're going to be looking at, and trying to pencil out how they're going to move their acres around to the most profitable allocation they can. Yeah. So anyway, a highly uncertain situation this spring. Obviously, this is going to keep feed prices elevated for dairy producers, for livestock and poultry producers, and that it will also erode margin, and that is going to delay whatever expansion we may see in those sectors. Now, we've been calling for milk to be in that class 3 milk to be in that $23 to $25 range for an extended period of time. Live cattle prices remain elevated and will probably continue to remain elevated as long as we see drought conditions out in the west, and perhaps a recovery in hog prices. But the issue here really is, what is the cost to respond to those high prices and expand your operation? And it's the input costs that are going to be, yes, commodity prices are elevated for farmers and ranchers and dairy producers, but it's the cost of production now that is becoming increasingly uncertain, unfortunately, that is going to be eroding those margins.
Right. Okay, so fertilizer prices going up, obviously. We just saw their predictive acreage reports be coming out next month here, I think. So we start looking at corn soybean mix and what that looks like, and ending stocks and all those things that play into that. There could be a lot more soybean acres get picked up than they had predicted based upon this, and corn acres go down, or some other crop will take their place and those kind of things. So I guess as you look at that, what's your thoughts there?
Yeah, USDA did come out with their ag outlook numbers yesterday. That was quite overshadowed by what was going on in the headlines and with what's going on in Ukraine and Russia. But they confirmed what everybody else is anticipating, a big increase or somewhat of an increase in soybean acres with corn acres down. Wheat acres are up when you've got, wheat prices the highest in several years now because of the conflict in Ukraine. That may increase wheat acres some. Remember, the winter wheat crop's already planted. The problem there is the drought on the plains. So it really comes down to what happens this spring up in the Dakotas in that area, and then perhaps later this fall. That's a long ways to go, but they're looking for cotton acres to also increase, and then rice acres coming up very slightly. But really, the story here is really going to be on soybeans. We've got beans well into the teens, and it's got a lower fertilizer bill than what corn or wheat or rice has. So USDA is pointing in that direction, what everybody was thinking anyway. But now, given the fertilizer situation as it is, that may be getting even worse. That may push yet again even more acres into soybeans than what USDA is projecting, and that would pull more acres out of the grains and rice, and that would perhaps tighten the feed situation even more again for this fall. Now, for harvest, for grain availability and feed availability this fall. Now, that would be a bad situation for the dairy and livestock and poultry feeders out there. So and if you're an ethanol producer as well. But really here, the big question is how many acres are going to be pushed over to soybeans and how much will be lost out of the grains. Then on the specialty crop side, for anybody out there, in California and the Sun Belt, it's, again, the story comes down to fertilizer. But if you're looking at permanent plantings, you're not going to be shifting. You're not going to be pulling trees because of fertilizer costs. Trees are a long-term investment. So it's not exactly like we're going to see a shift in acres out of almonds or walnuts or tree nuts or what have you, or citrus. This is mostly looking at what's happening in the row crops. And if you have a crop that's very nitrogen intensive, you're going to be relooking at your cost of production and where can you allocate acres to something that may have a lower fertilizer bill. And soybeans clearly is going to be one of those opportunities, perhaps.
Right. Yeah, there's kind of the $64,000 question out there right now is what that mix is going to look like based upon rotation and fertilizer and everything else that's there. So there's going to be a lot of looking at the spring going in that this could have as much volatility in the marketplace, add more volatility to the marketplace, and so it's already there just based on, right now I think when I looked it was like 88 million acres is what they had for soybeans and 92 million for corn, if I remember right.
That's right. Yeah.
If that gets flipped around and it's 88 corn and 92 soybeans, you know what I mean? That's a whole other thing. Even if it's just 50-50, you bring that down and you're you're 90 million each. That's a huge swing in
Absolutely.
And just ending stocks. And what does that look like? And where we're at now, especially with what's happening in South America, and you throw that on top of that, it was supposed to be the crop that was supposed to save everything and get world supply back together, and it fell pretty short of that. So a lot of volatility on that side of it. So I guess as you look out from just the whole economics of everything that's out there with the inflation, interest rates are going to be coming up. You start throwing all this stuff together. What's your kind of from shooting from the hip, I guess? What's your thought process right now going through the end of the year in the overall ag economy? I think prices are going to stay high, but there's, like you said, there's a ton of inputs coming in that really aren't accounted for in that.
Well, the margin environment's going to be compressed because of inputs. And I don't know how many farmers out there have already marketed their products or whatever it is they're growing, grains, livestock, oil seeds, dairy. But the inflationary environment is not going away. So we got to talk about the Fed.
Right.
Can the Fed control inflation? That's part of their mandate is to have stable prices. And what they mean by that is about 2% annual inflation. And right now we're at 7.5%. So can the Fed get get these costs under control? And there's a huge question mark on this because this time around, inflation is so much different. That's not necessarily demand driven. Because the Fed has no influence over Russia invading Ukraine. Mm-hmm. They have no influence over Nord Stream 2. The Fed has no influence over China perhaps invading Taiwan. These are things that may be that causing more inflation down the road that the Fed doesn't have any influence on. The trucker shortage that we're experiencing right now, elevated transportation costs. Coming into the pandemic, we were short about 70,000 long-haul truck drivers. That number is now about 80,000. And so that's lifting your transportation costs in addition to fuel surcharges. So the question is, can the Fed really douse inflation with high rates this time? If you go back to the 1980s, Jimmy Carter, late 1970s, put Paul Volcker in charge of the Fed to end inflation, and he did with interest rates at 20%, and that caused a recession and caused a collapse in asset values. For those folks that were around back then, they remember that farmland values dropped 60% from peak to trough. We're going to see that this time around again. Well, the Fed is between a rock and a hard place here because there's so much debt out there, and it's going to be hard for the market to bear a significant increase in interest rates. At the same time, you've got all these other factors of rising costs that the Fed doesn't necessarily have a lot of influence over. The Fed, again, doesn't have influence over China and whether they decide to shut down a port or a city or a factory because of a COVID outbreak. These type of things that cause higher prices in the United States may persist well through 2022, irrespective of what the Federal Reserve does on interest rates. So we could have an environment here where the Fed, which has already signaled that it's going to start raising rates in March. Some are speculating that they could raise rates by 50 basis points, which is unusual, instead of their traditional rate of 25 basis points. The last time they did 50 was back in the year 2000, 22 years ago. So they could start raising rates, and they could raise them sharply because inflation is now the highest in 40 years, 7.5%. It's the highest since 1982, I think. Yeah. So the Fed could overreact, perhaps, and raise rates a lot faster than what the market is anticipating. Currently, the market is anticipating a Fed to raise rates 3 to 5 times a year. Some economists are saying 7. Well, the Fed's going to have to thread a needle here. They could continue to see inflation rising because of these factors that are out of their control, and respond in an exuberant fashion, perhaps, and raise rates too fast and push the U.S. economy into a recession. Well, that would not be fun when you've got inflation still high and people losing their jobs.
Right.
That it would be the worst of worst worlds, a recession with rising prices. And that would mean would not be good for production agriculture. Borrowing costs would go up in addition to rising input costs and rising labor costs, perhaps. Maybe labor costs might come down, but it's a situation where that margin environment will probably remain very, very tight through the remainder of 2022, because costs really aren't going to respond automatically for those costs that do respond to higher interest rates. A lot of these other high costs, like energy and fertilizer and what have you, those costs may not come down until 2023. So it could be a while yet. And so for 2022, it's going to be an elevated margin environment. The USDA is forecasting that incomes will be down. Net farm income will be down in 2022. A lot of that is simply due to government transfer payments going away, or at least not being to the degree that we saw in prior years, with farmers and ranchers receiving the CFAP payments, the coronavirus payments, PPP loans, things like that, or the MFP payments from Trump. A lot of those payments are going to be going away. And so that is going to be the big reason why we see lower net farm income in 2022. But now you've got perhaps a situation here where inflation may be even worse for farmers and ranchers because of fertilizer prices and energy prices. And so that may drive incomes down even more. But again, it depends upon those farmers and ranchers who have not marketed their products yet. If they haven't done so, they're looking at sharply higher prices that they're going to benefit from. So there's a lot going on here. It'll be interesting to see how USDA responds to this. They're going to have to recalculate the cost side of the balance sheet for agriculture, and take another look at what the position farmers and ranchers are going to be in with commodity prices so high as well.
Yep.
A lot to figure in there.
A lot of stuff to look at here, Tanner. There's so much going on right now that we could probably do a 10-hour podcast and not cover everything. So plenty.
Yeah.
Plenty of crazy stuff happening here, man. So, well, Tanner, if folks want to reach out to you and get more information about what you're doing over at CoBank and what's going on over there, what's the best way to do that?
Just go to our website, cobank.com. They can find our research. On the website, our research division is called Knowledge Exchange. And you can contact us there, anyone on our team that focuses on all these issues that's going on. We've got a lot of people watching this, so we got a whole team you can reach out to.
Right on. Good stuff. Well, Tanner, appreciate you being on the podcast, man.
Thanks, Casey. Good to see you.
Good seeing you too, man. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram. That's where you find the latest editions of the Moving Iron Podcast. Also go to MovingIronLLC.com for all the information about the upcoming Moving Iron Summit in Nashville, September 6th, 7th, and 8th. That'll be in Nashville, downtown Hilton Hotel there. For more information, go there. You can send me an email at movingiron.summit@movingironllc.com, and I can get you all the information you need there. Or you can just check it out on the website and go ahead and sign up there. So if you're interested in doing that, highly recommend you coming and checking that out. So with that, I am Casey Seymour with Tanner Ehmke. Let's get smart, folks. Out.
Moving iron in the 21st century. Hardworking people working hard for